The FOMC meeting is behind us, the quarter rate hike is behind us, and gold is bouncing over the last couple of days, as you see. This is the chart that we looked at last time when we talked about gold support levels. And yes, I mentioned that I was actually expecting gold to drop only down to about 1920, but in fact gold on the spot market came down to just under 1900, just under 1900, a bit lower than expected, but I think now the daily cycle has finished yesterday. And we do have a bit of a bounce in gold. I think most likely perhaps up to the relatively round number of $2,000 over the next couple of weeks. But unfortunately, in the intermediate term, perhaps over the next several weeks, I do expect some softness in gold price. The reason for that is because I think the intermediate cycle is getting a little bit old, and perhaps over the next few weeks, we will see gold come down into the intermediate cycle low, into the end of the intermediate cycle, perhaps actually sometime around the FOMC meeting, which is on the 4th of May. The first daily cycle lasted for 44 days, second daily cycle lasted for 47 days. Now the ongoing intermediate cycle is around 90 days old. Usually these cycles last for around half a year. So this cycle is not really that old, and actually, now that I think about it, there might be still enough time for relatively good performance in gold, perhaps going a little bit higher above that $2,000 before coming down into that intermediate cycle low. But again, that's only the intermediate term outlook. In the longer term, switching to say monthly charts, we see a breakout of this cup and handle formation. And as I've mentioned already multiple times in some of my relatively older videos, the target gold price beyond this breakout is based on the depth of this cup, say somewhere around $1,000 or so. Put it on top of that breakout, and what we're going to see is a target somewhere around $2,800. For more details on longer term view on how Fed is going to help us pump gold despite their efforts to actually suppress gold prices, and on the longer-term relationship between CPI, money supply, and gold prices, see the videos linked down in the description. Next though, let's have a look at a couple of very important indicators, market sentiment and seasonality. But before that, let me just tell you that if you like this analysis, you are more than welcome to join us at myfinanceteacher.org, where, as you see, I do update the members on a regular basis, nearly daily, on a range of assets. Now let's look at the gold optimism index, which is very important because cycles are generally based on psychology. Cycles are based on market sentiment. Clearly, you do want to buy when there is this proverbial blood on the streets, when everybody is extremely fearful, and you want to trim your positions, sell at least some of your precious metals allocations or any other asset when the market is extremely excited, extremely greedy, or euphoric about the asset. Looking back at history, the vertical red lines over here indicate the last 6 intermediate cycle lows. And what we see is that these cycle lows over the last couple of years actually took place with the gold optimism index somewhere between 44 and 55, so somewhere around 50. But if you look further back historically, the intermediate cycle lows, or the very nice buying opportunities in gold, took place when the optimism index was somewhere around 30 rather than 50. Currently though, the optimism index is pretty high, it's above 60. And with a new rally into a new daily cycle, perhaps this optimism index will bounce back up to 70 again before coming down to maybe down to around 50 again, as it did over the last 6 intermediate cycle lows. And that's when you might think, well, perhaps that's enough of a fear on the market before gold bounces. But of course, the main question, the million-dollar question in that case, is that whether the prevailing fear on the market is going to become more extreme, as it usually did back historically, bringing the optimism down all the way down to 30 rather than 50. But again, with trillions and trillions of dollars being printed over the last couple of years. By the way, I've recently posted on Twitter and Facebook a quick news flash of an additional 1.5 trillions in extra spending. So for more details, you can find me on Twitter at myfinanceteacher, without the last letter R. There isn't enough space. Next, let's have a look at seasonality. And we do see a bit of dip in March, a bit of a bounce into early April, and then a bit of a decline into early May. So again, seasonality doesn't really contradict a likely intermediate cycle correction, intermediate cycle low, somewhere into the next FOMC meeting in early May, where, by the way, we again expect some Fed rate hikes. As I've been mentioning over the last few weeks, there might be some softness in gold price into yesterday's FOMC meeting, and we did see that. Again, in the long term, our $3,000 per ounce gold price is not impossible over the next perhaps a couple of years, but I think we might need your help with that. If you do want to see $3,000 gold price, what you gotta do right now is hit that like button, click the bell for the notifications, and of course, subscribe to the channel. Have a nice day. Bye-bye.